In January 2008, three people I know each had $200,000 invested and were each adding $1,000 a month. Identical balances in the same fund, with the transfer going out on the first of every month. Then 2008 happened. The market fell 37% over that calendar year, and by March of 2009, it had lost 57% from its peak. 10 years later, at the end of 2017, here is where the three of them stood. Ray had $691,000. He did nothing at all. The transfer kept going out on the first of every month, and he never once looked at the balance during the worst of it. Marcus had $523,000, which is $167,000 less than Ray. He sold near the bottom, sat in cash while he waited for things to feel safe again, and came back 4 years later. And Diane had $768,000. She did what Ray did, and for 2 years during the crash she also doubled her monthly contribution. $244,000 separates Diane from Marcus. That is more than either of them started with. They began with identical balances and lived through an identical decade. The extra money Diane put in during those 2 years came to $24,000. It turned into $77,000 more than Ray ended up with. That is better than 3 to 1 on a decision made while everybody else was selling. Right now the market is near a record high. It set a record in June, has slipped a few percent since, and every analyst on television is warning about a correction this autumn. So this is exactly the wrong time to be unprepared and exactly the right time to decide what you will do. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that is what you want, hit subscribe. Start with why a crash is mathematically good for somebody who is still buying. This is the part that feels wrong until you see it. When you invest a fixed amount every month, you are not buying dollars. You are buying shares, and the number of shares that fixed amount buys depends entirely on the price. Say a share costs $100, and you invest $1,000 a month. You get 10 shares. The market falls 20% and the share costs $80. That same 1,000 buys 12.5 shares. It falls further to $63, which is roughly what happened in 2009. Your 1,000 now buys almost 16 shares. Then it recovers, $70, then $85, then back to $100. Across those 6 months, you invested $6,000 and bought about 74 shares. Your average cost was $80.62. If the price had simply stayed at $100 the whole time, that same 6,000 would have bought 60 shares. The crash gave you 14 extra shares for exactly the same money. 24% more ownership, purchased with nothing but the willingness to keep going. That is the entire strategy, and it is why the title of this video is not clickbait. A crash is a discount on the thing you were going to buy anyway, but notice the condition buried in that. It only works if you are still buying. Which brings me to what actually separates Ray, Marcus, and Diane, because it was not intelligence, and it was not information. Marcus is not stupid, and he was not uninformed. He knew everything I have just told you about long-term averages. His portfolio had lost 1/3 of its value, and the news said it might lose another 1/3. His brain did what brains do when they see a threat. That reaction has a name in behavioral economics: loss aversion. The research going back to Kahneman and Tversky found something specific. The pain of losing an amount is roughly twice as strong as the pleasure of gaining the same amount. So a 37% decline does not feel like a 37% decline. It feels like something closer to a 70% emergency that is not a character flaw. It is the same wiring that kept your ancestors alive, and it is catastrophically miscalibrated for financial markets. There is a second reason selling is so damaging, and it is pure arithmetic. Losses and gains are not symmetrical. A 20% decline needs a 25% gain to get back to even. A 30% decline needs 43%. The 37% that Marcus lived through needed a 59% gain. And the 57% peak to trough decline of 2007 to 2009 needed the market to more than double. That asymmetry is why selling at the bottom is so much worse than it feels at the time. You do not just miss the recovery. You lock in a hole that needs a far larger gain to escape, and you climb out of it with less money working for you. Which means the solution cannot be to feel braver during the crash. Nobody feels braver during the crash. The solution is to make the decision before the fear arrives, and then remove your own ability to change it. So here's the strategy, and it has 4 parts. All 4 have to be set up now while the market is calm, because every one of them becomes impossible once the decline starts. All 4 parts are things you set up in advance. None of them requires you to predict anything, and none of them works if you wait. Part 1. Build the cash that stops you from selling. Marcus did not just sell out of fear. Crashes arrive alongside recessions, and recessions arrive alongside job losses. Somebody who has to raise money in the middle of a decline is not making a decision at all. So the first requirement is 3 to 6 months of essential expenses held in cash, in an account that is not your investment account. Essential means the bills that arrive whether or not you are working. 3 months if you have stable employment with good benefits. 6 if you are self-employed, on commission, or in an industry that cuts first. Right now, the best high-yield savings accounts pay a little over 4%. Inflation over the last 12 months ran about 3.5%, so that cash is barely gaining ground. That is fine because growing is not its job. Its job is to exist on the day the furnace dies during a bear market. That way, you are not forced to sell shares at the bottom to pay for it. Vanguard's research puts a number on how well this works. Participants with separate emergency savings were 43 percentage points less likely to cash out their retirement account when they change jobs. That is not a marginal improvement. It is the difference between a plan that survives and one that gets liquidated. Part 2. Automate the contribution so the crash never gets a vote. The most important thing about Ray's outcome is what he did not do. And the reason he did not do it is that no moment ever required him to decide. The transfer happened on the 1st of the month. He never opened an app, looked at a red number, and typed in an amount while feeling the way people felt in March 2009. If your contribution requires a monthly decision, you will eventually make that decision while frightened. Automation removes the decision entirely. This is the single cheapest part of the whole strategy, and it takes about 10 minutes to set up. Before that, it helps to know how often these actually happen. Most people treat a crash as a once-in-a-lifetime catastrophe, and it is nothing of the sort. A decline of 10% or more has happened roughly once a year on average. A drop of 20% or more is what people mean by a bear market. Those have come around every 4 to 5 years since 1932. The average one lasts about 289 days, so just under 10 months. For comparison, the average bull market runs about 965 days. More than 3 times as long, and the severe ones are rarer but entirely real. 1973 to 74, down 48%. The dot-com decline, down 49% with the Nasdaq losing nearly 80. 2007 to 9, down 57. 2020, down 34% in 5 weeks. 2022, down 25. If you invest for 30 years, you will live through all 3 categories. That is not a warning. It is a schedule, and is the reason a written plan is worth more than a prediction. Part 3. Decide your crash response in writing now while nothing is happening. This is the part almost nobody does, and it is what turned Diane's outcome into something better than Ray's. Write down what you will do at specific decline levels before you know when they will happen. At a 10% fall, which happens on average about once a year, you do nothing. That is not a crash, that is a Tuesday. At a 20% fall, which historically happens every 4 to 5 years, you do nothing and you resist the urge to check. At a 30% fall, you increase your contribution if you have the cash to do it. Write those 3 lines on a piece of paper and put it where you will find it. It sounds almost too simple to matter, and its entire value is that it exists before your judgment is compromised. When the decline comes and everything in you says stop, you are not making a fresh decision under pressure. You are following an instruction you gave yourself when you were calm and had all the same information. Part 4. Know where the extra money will come from because intention is not a funding source. Diane's advantage came from $24,000 deployed over 2 years. She did not find that money during the crash. She had decided in advance where it would come from. There are 3 realistic sources for most people, and none of them involves timing anything. The first is the emergency fund, and this is the one to be careful with. That money is not for buying the dip. It is for not selling the dip. Leave it alone. The second is any cash sitting beyond what the emergency fund needs. A lot of households discover they have been holding 2 years of expenses when they meant to hold 6 months. That surplus is currently losing to inflation, so moving part of it into a falling market is a better use than most people realize. The third is simply a temporary increase in the monthly contribution, funded by pausing discretionary spending for the duration. Not permanently. For the 12 to 24 months a serious decline typically lasts. Notice that Diane did not need a large sum. $24,000 over 2 years is $1,000 extra a month, and it produced $77,000 more than Ray. One more thing about the recoveries themselves, because it explains why being out of the market is so expensive. The largest single-day gains in market history cluster inside crashes rather than outside them. The 13th of October 2008, the market rose 11.6% in a day. 2 weeks later, another 10.8%. The 24th of March 2020, 9.4% in a single session. Every one of those happened while the decline was still underway, which is precisely when a panicked seller has already left. You will see a version of this presented as a study showing what happens if you miss the 10 best days. I am not going to use those numbers. That study assumes you somehow miss every good day while sitting through every bad one, which is not how anybody invests. The reliable part of it is simpler and does not need a statistic. The rebounds are concentrated in the period when it feels worst, and you have to be holding to receive them. Now, let me be honest about the parts of this that are harder than they sound. The first is that nobody knows how long a decline lasts, and the recovery is not on a schedule. The 2020 crash took about 5 weeks to fall 34% and about 5 months to recover fully. That was extraordinarily fast. The 2007 decline took roughly 17 months to bottom out and years to recover. The dot-com decline was worse. The Nasdaq lost nearly 80% and it did not reach its previous high again until 2015, 15 years later. So buying into a decline requires you to be genuinely comfortable with one possibility. It may keep declining for a long time after you buy. If that would break you, size the extra contribution smaller. The second honest point is about who this does not apply to. Everything I have described assumes you are still adding money. A crash is a discount for a buyer. If you are retired and withdrawing, the identical crash does the opposite. You are selling shares to fund your living costs, and a decline means selling more of them to raise the same dollars. Those shares are then not there for the recovery. That is sequence risk, and it is the mirror image of everything in this video. I have made a full video on it. The summary is that the 5 years before and after you stop working are when a decline does the most permanent damage. If that is where you are, the strategy is not to buy the dip. It is to have enough in cash and stable assets that you can leave the stocks alone for 2 or 3 years while they recover. The third is that I have used specific historical numbers throughout, and history is a sample rather than a guarantee. American stocks recovered from every decline in the last century, which is why this strategy has worked. That record is real, and it is not a law of physics. And the fourth is that I am not telling you a crash is coming. I do not know, and neither does anybody warning you about one on television. What I know is the frequency. 10% declines have happened roughly annually, 20% declines every 4 to 5 years, and 30% declines a few times per generation. If you invest for 30 years, you will live through all of them. So the question was never whether to predict the next one. It is whether the decision you will make during it has already been made. So here's what to do this week, and none of it takes long. Check your emergency fund first. If it is under 3 months of essential expenses, that is the priority, and it comes before any of the rest. Then check that your contribution is automatic. If you are transferring money manually each month, change it today, because that manual step is where the plan breaks. Then, write your 3 lines. At 10% you do nothing, at 20% you do nothing, and at 30% you increase if the cash is there. Sign it and date it, because the date is what tells your future self you decided this calmly. And then identify where extra money would come from if a serious decline arrived, and write that down too. There's one more thing worth saying about Diane, because her advantage looks larger than it was. She did not call the bottom. She increased her contributions during 2008 and 2009, which means a good deal of the extra money went in while the market was still falling. Some of it bought shares that were down another 20% within months. She did not care, and that is the point. She was not trying to buy at the lowest price. She was buying at prices that are lower than they had been, on a schedule she had decided in advance. That distinction matters because it removes the thing that makes people freeze. You are not trying to be right about timing. You are trying to be present during a period when everything is on sale. Any price during that period beats the price before it started. That is the whole strategy, and notice what is missing from it. There is no prediction, no timing, and nothing that requires you to be smarter than anybody else. Ray got a good outcome by doing nothing, and that was only possible because nothing was ever required of him. The automation made his best decision for him every month without asking. Diane got a better one by deciding in advance what she would do and then doing it while it felt terrible. Marcus made one decision in one bad month. It cost him $167,000 against a man who was not paying attention. Notice that the crash itself is not what determines which of those three you become. What determines it is what you set up while the market was calm, which, as of today, is right now. If this was worth your time, hit subscribe. I will see you in the next one.